Good afternoon, good morning, and good evening, folks, from wherever you're dialing into this webinar today. My name is Brett Evans, and I'm the Managing Director for the Europe, Middle East and Africa region, joined by my colleagues, Mr. Adam Prentice, who's one of the financial planners here in the UAE office, as well as Mr. Ben Turner, who's the Managing Director of Atlas Tax down in Adelaide. G'day, gents.
G'day, how are you both?
We're good. We're good. A lot to talk about. Don't want to give the good stuff away to the attendees, but the good news is we're not as destitute as our friends, colleagues, and families back in Australia, which is a good thing. And again, anyone who's been reading the Australian press would certainly think that the end of the world and the four horsemen of the apocalypse is coming around the corner tomorrow. So let's get the show on the road, and I think we'll just run through a couple of issues on the budget for and what it means for Australian expats. So let's start clicking the buttons here. No presentation by any licensed professional, legitimate professional, not dodgy person, will be without a disclaimer. So all this information pretty much up on the screen says that the information we're going to talk about with you good folks today will be educational and informational purposes only. Please do not construe that as personal advice. If you do think it's personal advice, then you need to reach out to a licensed tax accountant, lawyer, financial advisor, whoever you may need, someone like Atlas. We have two disclaimers because we're a dual license firm. So this just refers to how we are regulated in the UAE. Here in the DIFC, we're actually the only Australian firm in the Gulf region that is dual license, both in the local region as well as back in Australia. So it's a very proud hat that we like to wear. A bit about who is Atlas Wealth Group. We're the leading provider of Australian expat tax, financial advice, mortgage, asset management services. Pretty much think of your wallet from a financial perspective. We've been doing this. This is our 15th year later this year. So it's not our first rodeo, and we've done this a lot. We're regulated by all the acronyms, ASIC, the ATO, and the Dubai Financial Services Authority. And what that means is the advice that we provide to our clients is not only regulated, but compliant. And that's the most important part. We have clients in over 50 countries. I think last count was about 62 or 63. Clients keep moving around, so we just say over. It's probably the easiest way to say that. We manage over $500 million in assets on behalf of clients, and all of our specialists are degree qualified with numerous postgraduate certifications. That's an important part I'd like to make because there's a lot of folks out there running around calling themselves advisors. When you look at their LinkedIn profile or look at their background, they don't actually have any high qualifications that enable them to provide that high level of service that we like to provide to our clients. Today, we're going to run through a couple of quick points, and then we'll obviously give as much time as possible to the Q&A at the end, which is always well received. First of all, I'll run through a budget at a glance and then talk about the changes to property. I'll then hand it over to Adam, who will talk about Australian shares and superannuation. And then obviously Ben's turn onto the Australian trusts, and then the all-important Q&A. You are able to enter questions when we run through that. So as we're talking, put your questions in the Q&A section, and then we'll run through all those at the end. So just say stop starting, we can get a nice flow going, give you all that information you need, and then we'll run that Q&A at the end. So let's get the show on the road. Budget at a glance. Now, in the past, I always used to like to put up treasury estimates and the numbers that sort of give the budget that substance in terms of doing it. I've stopped doing it for the last 2 years because when I've gone back and looked at those numbers, they're nonsense. I think those numbers are self-serving, and I prefer to use independent data like the Australian Bureau of Stats or the numbers that the Reserve Bank use when it comes to growth forecasts and unemployment forecasts and those sort of things, because I think there is a bit of smoke and daggers that does go on in the background. And to me, that would be a situation where we'll be leading you astray if we started putting up numbers where those numbers didn't come out to fruition. Not a lot in terms of general sort of updates that affect expats when it comes to looking at some of the key issues. The legislative rate cuts continue. This is from stuff that's been legislated many, many years ago. And this is the stage 3 cuts that we've been talking about for the last 3 to 4 years. The marginal tax rate is coming down from 16% down to 15% for that 18 to $45,000 bracket, and then 14% down from 1 July 2027. This has been already legislated. Everyone's crowing on about it and sort of claiming it, but this has already been in the kitchen and baking already. We have the new WATO allowance, which is a new annual tax offset from the 2027 to 28 income year. Adam and I ran this seminar last week, both in Dubai and Abu Dhabi, and a lot of expats were asking, can they get access to WATO? And the answer is no. We also have the $1,000 instant tax deduction. I'll pick Bren's brains in the Q&A section, but I think that's a bit of a smoke and mirrors exercise as well, because when I looked at virtually what they're saying is you can claim $1,000 automatically without having to show receipts, but they've actually removed some of the claims you can make out of a list of available claims. And when I look back when I was a tax resident and looked at some of the claims I was making, I'd be about $1,200 worse off not being able to claim some of the things there. So I'll pick Ben's brains later on in that call. So let's get on to the Australian property, which has probably been the lion's share or the elephant in the room that most folks are talking back in Australia. So what's actually happening with this? The long and the short of it, from the 1st of July 2027, we're going to have a 50% capital gains tax discount replaced with cost-based indexation, plus a 30% minimum tax on net capital gains. Now, all this might sound like, like clear as mud sort of situation. Expats will remember back on the 12th of May, the 8th of May 2012, when we lost the 50% discount availability to our properties that we held back in Australia as a non-resident. So essentially what this does is it means that the tax residents are going to go through a very similar thing where they're going to have two cost bases, or two calculations, we should say, when it comes to calculating their property. Those properties they currently hold up until the 1st of July 2027 will be eligible for 50%, and those properties post 1 July 2027 will be under the new indexation, and as well, obviously, any new properties will get the new method as well. The only exception to that will certainly be new residential property getting a high discount. Obviously, they can either choose to either do the 50% discount or the cost basis indexation. A lot of questions last week and a lot of questions you see online. What is indexation? What does that mean? Like, what's the relative number? And what we've tried to do here is paint a picture as to what that looks like from a mum and dad's point of view. So we ran a number, a bit of a calculations, got the calculator out. And this is based on the assumption of a tax resident on the top marginal tax rate buying a property for $500,000, and that property going over a 15-year period up to $1.5 million. In order for the indexation method, which is the new method coming in order for it to be better off than the current 50% discount situation, is it has to average 4.7% over that 15-year period. Now, we got people to put their hands up in the seminar last week and said, okay, right, how many people here know what the current inflation rate is? And very few were able to do that. So what we've done here is grabbed our friends' data from the ABS. As I said, it's one of my number one places for information. And just to give you a context as to how audacious that 4.7% average over a 15-year period has to be. And as you can see here, this is CPI going back into the 80s. And as you can see there, very rarely is inflation above 4.7%. And if it is, it's there usually for a short amount of time, but certainly not for a 15-year period. So for the vast majority of people who buy a property post 1 July 2027, they are going to be worse off. The only time I think in my mind that you wouldn't be worse off is actually if you didn't actually achieve a lot of growth at all. In that case, you'd only be capped at that 30% gain if it was marginal. So long story short, it is quite a convoluted way of increasing taxes on property, but also too, it's going to really make that calculation decision. And Adam and I asked a question in the audience back last week. Any accountants in the room, a couple of people put their hands up, and Ben included here. They're going to be very busy and they've virtually got a job for life, because working out how much tax you owe to the ATO isn't essentially going to be half the gain that you've made in terms of applying that to your marginal tax rate. It's going to be going back over the period of holding the property and working out any pre 50% discounts and post indexation methods, and then what is the indexation or what is the inflation in those particular periods of time. So it is going to be like tapping your head and rubbing your stomach at the same time. So what does this mean for expats? Long story short, non-residents have not been able to access the 50% capital gains tax discount for a period since the 8th of May 2012. So we don't really lose anything there. But one thing we may gain is by abolishing the discount and introducing the indexation method, it may open the door for expats to actually be able to use the indexation method to try and reduce the accessible gains. Because right now, if you bought a property as an expat, held it for 10 years, and you made 100% return, you would pay capital gains tax on that 100%. Now, the devil's in the detail, and you'll hear both myself, Adam, and Ben refer many times through this webinar saying we are going to need to wait to see the legislation, the draft legislation that Canberra will draft on the back of these announcements to get more detail, because if there's no exclusion for expats, it's a win. If there's an exclusion for expats, then obviously that's something we're not going to benefit from. Next big thing for property is no negative gearing, and it's only be limited to new builds. So from 1 July 2027, losses are only deductible against rental income or capital gains from residential property. Now, once again, expats never had the benefit of negative gearing, but certainly this will affect a lot of people in Australia who rely on negative gearing to fund that gap. So essentially, excess losses will be carried forward indefinitely. What does that sound like? If you're putting your hand in your pocket every year for $10,000, then you hold the property for 10 years, then a loss accrual will build up in the order of about $100,000, that $10,000 a year for 10 years. New builds, build to rent, and properties and super funds and widely held trusts are exempt, which is good news for those folks. But in my mind, and I'm always happy to be proven wrong, I don't think a lot of people buy new builds to negative gear. So it's going to be interesting to see how that demand goes. The good news is grandfathering of properties. So properties that owned or signed contracts before the cutoff kept this treatment. So if you do own a property that is negative geared and you are currently a tax resident, because we do have folks on the call at the moment who are in Oz, then in your case, you can continue to negative gear that property. One of the questions I always like to throw, Ben, some Dorothy Dix questions at the end. I'll say that to you, but long story short, grandfathering existing properties, if you bought or signed a contract or owned a property before 7:30 p.m. on budget night. So from an expat's point of view, if you're looking to buy property overseas, the math has totally changed. So in the past, you could accrue income tax losses through your working period and then offset them against your income when you return to work in Australia. Now you only get back the benefit back when the property becomes positively geared, or potentially when you eventually sell the property. So what folks need to do is when they're looking at buying a property is look at the ROI on that property. If you're putting in your pocket $10,000, $15,000, $20,000 a year and it's accruing these income losses in the background, and the only reason why you're buying that property is for that reason, you may need to consider other asset classes. And the reason I say that is if you put $10,000 a year for 10 years, that's $100,000. Your income tax losses do not compound or accrue any sort of returns. Whereas if you put $10,000 into a ETF every year for 10 years and you earn 7.2% on that return, that'd be worth $167,000. Just the power of compounding, giving those returns. And then don't forget, as non-residents, we do not accrue capital gains tax liabilities on those non-taxable Australian property, which is what shares, ETFs, and those sort of things are. So you need to really run the maths more. In the past, people would have bought properties in Australia with the idea of growth. Now you have the scenario where interest rates are going up. That's a headwind. Tax rules are changing. That's a headwind. Banks are now already starting to change their lending policies. So even though these rules haven't come in, the banks are already discounting the ability to go out and use negative gearing to plug that gap. So if you think of an Australian resident, they're going to have to start to really change their methodology when it comes to what property they're going to buy. From an expat's point of view, there is another silver lining. So if you consider probably negative gearing by 10K per annum for 10 years whilst non-resident, you get $100,000 in carried forward losses when you return to Australia. Now, if you return to Australia and say you're on a $200,000 salary, but you arrive on the 1st of January, so in repatriation year, the taxable salary is only half. You're only there for half the financial year. Under the current treatment, the repatriation year, 100K salary plus wages is fully offset by the losses you've accrued overseas. Now, remember, 100K salary, you're not on a high marginal tax rate. So what you actually get back is a benefit, which is about 22.7% in the equivalent tax rate that you receive in that benefit. Now, under the new proposal, losses quarantine until the property is positively geared, assuming a 10K a year positively geared or capital gains tax on sale, likely all your losses, and once again, this is the devil will be in the detail when the legislation is released, likely all your losses will be utilised against income in the top marginal tax bracket. So that same amount, you essentially get a 47% or a $47,000 tax benefit, though your time frame is delayed. So if obviously you return to Australia in a couple of years' time, then you get in 10 years' time, you get that benefit. But if you hold the property, you have to wait to sell that property to get that benefit, or alternatively wait for that property to be positively geared. Right, I'll hand you over to Adam now. He's going to run us through shares.
Perfect. Thank you, Brett, and great to see so many people on the call. But I guess that is what happens when there are the biggest budget changes in 3 decades. So hopefully, we gave you some insights on this sort of stuff. Brett, could you just flick to the next slide, please? All right, shares. So shares will be treated the same as property. This applies to all CGT assets, so shares, ETFs, managed funds, even cryptocurrency falls within this realm. So just to refresh the brains, as I know when I was going through this, there was a bit of a headache. Just going through a bit of a live example. So if I bought Commonwealth Bank in 2020, let's say for 50,000 Oz, and on 1 July, it was worth 150,000. This is me as an Australian tax resident. So I have an unrealized gain of 100,000 Aussie dollars. With that 50% discount up to that point, I will only pay tax on the 50,000. So that's 50% of the $100,000 gain at my marginal tax rate. However, if I haven't sold this on 1st of July 2027, that gain is locked away. So essentially on 1 July 2027, my shares are worth 150,000. It's essentially like I've purchased a new share as at that date. So this is my cost base for the indexation method. Essentially, inflation will apply to that, and my cost base will increase accordingly. However, now they've introduced a minimum 30% tax on that gain from that point forward. So if my marginal tax rate is in the 16% bracket, it doesn't matter. I'll still get taxed 30%. Really highlights the inequity of, the younger generation. You probably put money in an ETF to save away for that property. Now that it is sort of ruined because of that 30% tax bracket. Right, over to the next slide. So the good news is for us as non-residents of Australia, we're not subject to capital gains tax on shares, ETFs, etc. This has not changed, so that's a really good element to it. However, there is an exception if you haven't done something called a deemed disposal upon leaving Australia. I'm sure a lot of you on the call we would have discussed this with, but for everyone who doesn't know about it, essentially, if I am an Australian resident and I leave Australia today to go overseas, I have the option to say to the Australian Tax Office, okay, this is the gain of my assets from my time period as a non-resident. I get the 50% discount and I will pay the tax on that amount. The benefit of doing that is from that point forward, whilst I'm overseas, I will not accrue a capital gains tax liability with the ATO. It is what I call an exit tax out of Australia, but where it does benefit us is building capital gains tax free from that point forward. So it is very important if you are in this situation to have a look at your position prior to 1 July 2027. Otherwise, from that point forward, you will be subject to the indexation. All right, Australian super and pensions. So contribution caps, preservation ages. Brett, you just want to go to the next slide? Contribution caps, preservation ages, and tax treatment of complying super funds have largely been unchanged. So just a reminder for everyone, tax inside superannuation is 15% on income and either 10 or 15% on capital gains, and that depends on whether you've held the asset for over 12 months. The new rule is for super funds over 3 million, where an additional 15% will be charged on earnings. This tax actually can't be taken out of the super fund. It has to be paid personally too, which is an interesting one. However, this change has been better than what was originally proposed. Originally, they were proposing a additional 15% tax on the unrealized gain, which is the growth of the assets, which, to put it lightly, not speaking badly about the ATO, would have been a big step in the wrong direction. There has also been another positive change. This is to do with the pension supplement. So this is an additional supplement payment in addition to the age pension. It's for things like everyday costs, utilities, phone, internet, and medicine. So this has been increased for persons overseas to 12 weeks as opposed to 6 weeks. Next slide, Brett. What these changes have showed is the emphasis on how tax effective superannuation is. So a 10% capital gains as opposed to the 30% minimum, which is on indexation for marginal tax rates, it doesn't compare really, particularly if you're on a 47% tax bracket. Super is very important for us overseas. Some countries, UAE, Saudi Arabia, we don't have as good as retirement funds as superannuation is. So it is important to have a look at that position. Otherwise, our mates back in Australia earning 12% of their salary put into super, we could come out as a disadvantage. A common myth, Brett and I always get is, I can't contribute to super because I'm a non-resident. This isn't true. You still can contribute to super. It might just be a different type of contribution to what you're used to. The contribution we are used to is our employers putting money into super for us, which decreases our Australian taxable income. It's called a concessional contribution or a pre-tax contribution. If you don't have any Australian income, that contribution might not be worthwhile for you whilst you're overseas. But what we can make is non-concessional or after-tax contributions. This goes in the fund tax-free and can build in that tax-effective environment. Contribution cap for that's 120,000. So there is scope to make those larger, lumpier contributions. SMSF, so we have chucked this in there, and what we used to think was the Labor government hated two things. One was non-residents, and the other was self-managed super funds. But seems after these changes, they just hate everyone. But self-managed super funds, so you are at risk for breaching two of the tests whilst living overseas. The first is central management and control has to be within Australia. These are the day-to-day decisions, investment decisions that have to be made. If you are living overseas, this could breach this test. The second one's the active asset test. So this is if your balance is over 50% of the self-managed super fund balance and you're a non-resident contributing, that fails this test. So just a warning on that side, be careful with self-managed super funds. Fortunately, they weren't touched by the budget, but yeah, those rules are still in place.
Fantastic. Thanks, Adam. We'll kick it over to Ben now, who will talk about that exciting topic of Australian trusts and yeah, where we're going with that.
Yeah, well, this is a little bit of a sleeper in the lead up to the budget. There's a lot of talk on capital gains tax changes, but you kind of had to have your finger on the pulse to hear about the trust changes, and they are quite significant for those that are affected. Um, in a real broad sense, what they're looking to do is to put a minimum tax rate of 30% on trust distributions, which is, for some people, quite a huge impact. And the way that will actually work is by having the trust itself be taxed. So typically you'd have your tax return for your trust prepared. As long as everything is distributed throughout the year to beneficiaries, then there's no trust tax to be paid. It all just flows through on the normal sort of process, but the change here will be that the trust tax return will actually have a 30% minimum tax, and then that will flow through as a credit or a non-refundable credit in certain circumstances as well. So that's how the mechanism will work. Really the thing they're targeting is discretionary trusts. So you'll have certain trusts that are not impacted, and they include fixed trust, widely held trusts, super funds, disability trusts, deceased estates, and those sorts of things, including charitable trusts. Now, deceased estates, I would put a bit of an asterisk on, because if it's a testamentary trust that is created, then that is actually captured by this. So this is what people are sort of highlighting to the government at the moment is, a stealth death tax, in waiting, and quite rightly is putting a lot of people's noses out of joint. So just to give you an example of how that might work, you have a will put in place, you want your assets to go to your next of kin. Perhaps they haven't reached a certain age yet, so you want to sort of manage how they receive that income, perhaps over time, and then so you set up a testamentary trust that gives the trustee the power to effectively filter that income to or the trust estate to those beneficiaries over time. These rules specify that on those distributions, there'll be a 30% tax to be paid on those distributions. Whereas if you just pass those assets directly to those individuals on death, there'd be no tax at all. So there's a real inequity between those scenarios, and anyone who's got a will in place with a testamentary trust probably needs to review their circumstances to see if that's the best vehicle for them going forward. There is an ability to revise the structures you've got in place over the next couple of years. So they've got a 3-year window where they're going to allow you to restructure discretionary trusts into other vehicles. I'd like to see the detail of that legislation to see exactly what they're allowing. But it looks like, pushing through to company structures or fixed trusts without there being a capital gains tax events on, say, property and things like that. So we might see a lot of restructuring of these particular assets, and that will apply. Now, fixed trusts and companies, the downside for those is that it's very hard to stream particular income to the beneficiaries on a different basis, on a year after year basis. So you might have a situation where you have some children who are going through uni and they are on lower tax brackets. Typically, they would be the recipients of trust income then, but then say that they start working and they're in higher tax brackets, and parents have stopped working and now retired, then they may be the logical people who you distribute to in the normal traditional discretionary trust environment. So in a fixed trust, you lose that ability because everything is specified as to their ownership percentages of units or shares as to how much they'll receive each year. And so it does take away some of that, the key benefits of what a discretionary trust can do. So if someone is in a tax-free threshold or the 15% tax bracket, this system that they're bringing in will effectively say, yes, normally you would not pay any more than your marginal tax rates in your personal return, but here you're actually going to be losing by paying the 30% tax at the trust level and then losing any excess from that, you're actually still paying 30% overall. So not a great outcome from that perspective. Even worse for situations if you've got, say, a bucket company or something like that put in place, because my understanding of the current rules is that if you distribute to a bucket company, you don't get a credit for that 30% tax paid, and then the bucket company could be paying another 30% tax as well. So you could be getting tax stacked on top of tax in that regard as well. So there is obviously something we'll need to look carefully at when the legislation comes out to see how it all works. There's a lot of chatter online about potential new structures that might be in place, but we'll see what they put in place. I don't think some of that chatter is too helpful, because if the government gets wind of that now, then they might put in place stops so that that's kind of covered by the time the legislation arrives. So on the next slide there, Brett, some key things as applicable to expats is that if there are non-resident withholding tax components, that's excluded from these calculations. So that is, I guess, positive. We talked about the 3-year rollover relief as well, applying as well, allowing you to restructure. And if you are returning to Australia and you're wanting to examine how you hold your investments, perhaps a discretionary trust structure may not be the best vehicle anymore, especially when compounded with things like the CGT discount, the way that that has typically applied. Holding assets in companies may actually be something that a lot of people start taking up going forward. So with that, I think it might be worthwhile if we move on to the Q&A, where we can hopefully answer as many questions as you can throw at us.
Spot on, mate. Good timing there, and yeah, lots of questions coming through. So as I suspected, they're all going to be heading in your direction, mate. So grab yourself a glass of water, because the rapid fire questions start now. Anonymous attendee asked the question, what items are no longer tax deductible? And I think they're referring to that $1,000 automatic deduction method.
Mm-hmm. Yeah, well, the $1,000 deduction method, well, firstly, it's linked to work-related expenses. So anyone who's a non-resident who's not working in Australia getting taxable income that they're reporting, they don't get that $1,000. It's talking about work-related expenses, so you have to be effectively having pay-as-you-go, salary and wages, that links to that, and it's just basically saying that you don't need to do receipts anymore for that. But as soon as you want to claim more than $1,000, then you're going to need receipts for the whole lot. So it's not like they're excluding particular classes as such. It's just that you need to keep receipts for anything that's above 1,000, and it's not just the incremental amount above 1,000. As soon as you go above 1,000, you need to keep receipts for everything.
Yep, good answer there, mate. And straight off to Josh now, who asked the question, does the excess losses carry over with negative gearing get indexed?
It's a good question. Losses never get indexed, unfortunately. So I suspect they will not apply indexation to that particular circumstance. So historically, we've never had losses being indexed. So I very much doubt that.
Yeah, and that's what the example I gave before. You just got to run your maths in terms of compounding, indexing, and see not just throwing money down the drain. If you're not getting capital growth on one side and you're putting a truckload of cash in, the maths behind what you invest in might change after these new announcements are introduced. Right, a question for Andrew. Thank you, guys. If currently a AU resident and allowed to continue negative gearing existing property, is there any change to this if I then become an expat again before or after 1 July 2027?
So the residency aspect has not had any impact on these changes based on any announcements. So you're actually comparing two different things. They won't actually intersect as far as I expect. Becoming a resident or not should not impact that aspect.
Okay, and just while we take a break for the questions there to keep loading up, I've got a question for you, Ben. And I thought of this
Mm-hmm.
the other night. If I owned a property and it was a principal post resident, so it doesn't apply to anyone pretty much on this call unless you are back in Australia preparing to move, and I made that property a negative geared investment property post the changes, do you think they'll allow that? Because technically as a budget night, I own the property and it wasn't purchased after that date. So do you think that's going to
Mm-hmm.
enable a bit of a window there for folks to be able to negative gear property in hindsight?
Yes, and there's been a bit of talk on that actually lately with people saying that it's going to have an impact where people who have their main residence rather than selling and upgrading, they might just hang on to their main residence, and the proposition for maintaining their former home and then renting it out has greater benefit to them rather than sort of just selling to upgrade, if that makes sense. So because of that, you know, from everything I've seen, you should qualify for the negative gearing aspect. It just, like you said, says that you have to have held the property prior to departing. The fact that you change your use of that property is disregarded. It's not a relevant consideration. I would just say to people, if they are thinking about that as a strategy, you probably want to be having your loan not paid down, but instead having an offset account in place, because a lot of people, after they're in their house 5, 10, 15 years, they've paid down the loan quite significantly, and they may not be negatively geared or negatively geared for long. So if you're thinking of doing that, you can't just go and redraw money and then inflate the loan and claim it as negatively geared. You have to be sort of thinking about that and making sure that it's via an offset account that you could then pull the money out of to be able to activate all of that interest as deductible.
And I think the important point to mention too is offset account, not redraw. We had that discussion last week as well
Exactly.
too. There is a monster difference out there, folks, between
Mm-hmm.
private debt and tax deductible debt. So don't assume that a redraw is the same as an offset account because it's completely different in the eyes of the ATO. Right, guys, we'll carrying on. We've got lots of questions, so let's get through them now. So Kerry here asked a question. I own only one property in Australia. It was my residence from purchase in 1992 until I moved overseas for work in 2004. I'm now retired and living in the UK. I intend to return to Australia in 2030 permanently. I understand that currently if I sell this property, I pay capital gains tax, even though it was my one and only residence, 100%. My preference would be to sell it to move into a property that is more suitable for my age and health. However, capital gains tax will make it impossible for me to buy a comparable property with a better layout. Is anything changing in this regard? And I will preface this, and there's some other questions as well too, with that none of this is personal advice, folks. So we're talking general concepts in nature, but we'll always try and tread that fine line of giving you the answer while not putting us in jail. Over to you, Ben.
Mm-hmm. Yeah, I don't think I heard whether or not the property was rented, but I think it's safe to assume the property would have been rented after departing Australia, because, you know, just for argument's sake, if it was never rented, then you could come back to Australia, resume residency, and potentially be completely exempt under the main residence exemption. There's other things to consider there. For example, if you had another main residence overseas that you were treating as your main residence, then that may not apply, although typically we would look at both and consider that. Assuming it was rented, so you've gone past the 6 years, then you would expect that as a tax resident, so if you come back and sell whilst resident, you get a more favourable outcome than selling whilst non-resident. But given the amount of time we're talking about in this scenario, there still sounds like there's quite a reasonable amount of tax to pay on a proportionate basis of how much of that ownership period was considered your main residence versus not.
Yeah, so just virtually pro-ratering, that time period, and there is going to be the piper to pay and a pound of flesh to be taken, but with a proper strategy, a little bit of mitigation.
Mm-hmm. Yeah, absolutely, and do what you can to maximise the cost basis of that as well for that period that you lived in it, which can be hard to reclaim, well, to rebuild after you've
Yep.
It's been 1992 to 2004. It's a long time ago to try and keep records, but
That's right.
a lesson for those people who are thinking about it now, or that it might happen to them in 10, 15 years' time. Keep all of your records for your primary residence if you can on the consumption costs that you, non-consumption based costs, council rates, body corporate, maintenance, all those sorts of things that you have on the main residence, because you never know if you're going to need to pull them out sometime in the future.
Keep your accountant happy is what you're trying to say, because your accountant's job becomes a nightmare if you don't have your records. We get it. Yeah, we all preach the converted. Right, a question from Ben. For properties held prior to 1 July 2027, do the changes mean that any carried forward tax losses on those properties accrued prior to 1 July 27 can be used against salary income on return to Australia, or will those be quarantined as well?
Sorry, so that question was in relation to losses.
He's wondering,
Right.
if he's been accruing income losses, can he continue to do that and return to Australia at a future point in time, or after 1 July, does he can only, even though his property qualifies as under the old scheme, in terms of being able to negative
Yeah.
gear, can he still use those income losses that he continues to accrue against his personal services income as opposed to rental income or capital gains in the future?
Yeah, so the key thing is it's not 1st July 2027 as such, it's the budget night. So 12th of May 2026, whether you held the property at that point in time, then the negative gearing aspect still applies. So that gives you the full breadth of losses to apply in the future against all income classes.
Okay, so what's the old saying, TLDR, yes, doesn't get quarantined as long as it was negative geared prior to budget night.
As long as it was owned prior to budget night. It didn't have to be negatively geared. Circling back to that point that you had, the property just has to be owned.
Okay,
at that point.
Amazing. Right, yeah, next question from Sean. Regarding property changes, how does the new budget change things should I inherit a property while I am an expat?
Depends, I guess, on a few things. If it's Australian property, if it's a foreign property. But in certain circumstances, I mean, there was nothing in this budget as such that specifically changed the landscape in relation to that. Typically, if it was a foreign property, there shouldn't be any tax to pay on that. If it was an Australian-based property, you need to work through any of the concessions that might be available. Typically, we'd look at the main residence exemption. But if there was taxable components on the sale of that property, then that would all need to be worked through systematically. And without sort of numbers in front of me, it's really sort of hard to sort of give you an exact number on that. But on this budget announcement, there was nothing as such that I can think of that should change the dial there.
Okay, amazing. Okay, on to the next question from Anonymous. If we have moved recently, i.e. still within the same financial year, should we have lodged and notified the ATO already of our non-tax residency? I was under the impression that this should be done at tax time.
Typically, you do that at tax time. There's no formal lodgement as such prior to then. So there's often a bit of a lag between when the ATO knows that you're a tax resident, although they've got other things they can check at the time. If you're doing like a sale of property, they'll check your immigration data, etc. But yeah, the tax return's fine to be the disclosure on that.
And also looping back to Adam's comment before about deemed disposal, that's also when you do that deemed disposal if you choose to elect to accept it. Okay,
Yep,
on to the
exactly
next question from John. Reference the changes to Oz property and capital gains tax. If the property is eventually sold but owned prior and post the changes, is the newer ruling applicable for the whole period of ownership, or would the owner need to get a valuation in June 27 to calculate the gains? Ben and I were having this conversation offline before, saying we actually want to have and Adam as well, saying how we actually want to have a valuation business because those guys and girls are going to get very, very busy, both up to we can't do future forecasts, but it'll be certainly from 1 July onwards from there. On to the next question here from Stefan. If an invested property is on a interest-only loan, would refinancing the loan to restart the interest-only period and likely prolong the period the property is making a loss affect your ability to negative gear?
No, that shouldn't impact. As long as you're not touching the loan balance in doing
Yep.
that, if you're not taking it extra, then you're welcome to go and work out whichever interest works best for you. That shouldn't otherwise impact that.
Okay, amazing. Don't worry, Adam, there's some questions coming up for you too, mate, so you've been very patient there. Was there any mention from Anonymous, was there any mention or coverage on the proposed changes to the non-tax residency framework and the test structure?
No, there wasn't. Nothing that I could see. There's no mention of non-residency at all, including any residency rules changes either, or some SMSF leniency, which has all sort of previously been announced, but for my understanding, it's all been mothballed, any of those sorts of aspects. So yes, I would love to see in the draft legislation whether some of those are considered. Maybe there's just it's not big enough to make an announcement on, but
yeah.
So,
and that's why, as we said at the beginning, it's all about the devil's in the detail. So as soon as we get that draft legislation on our hands, and I actually put up on the screen here our social media accounts as well too, folks, because we will be obviously broadcasting ad nauseum over the coming months any changes or tweaks or little nuggets that we find when this information is released. Joe, our marketing communications manager, sitting over there, puts all these webinars together and does an amazing job of seminars, webinars and events and everything, as well as the pages. Make her happy, guys. Just go on and follow, like, subscribe, all the usual jazz that all the people say. She loves watching the numbers go up. So makes her happy. She skips out of here at the end of the day, and happy days. So just while I get on the screen there, go on and jump on board. Next question for Edward. Read the exclusion of assets of discretionary testamentary trusts existing at announcement. Does this mean that existing trusts are excluded for all time, or is that the 3-year window is for, i.e. we have 3 years to restructure existing trusts if needed?
Yeah, you've got 3 years to restructure the existing trusts.
Yep.
There's no grandfathering of existing trust relationships. So that's what that period's for.
Fantastic. Okay, Adam, showtime. From Dale, with the importance of super's lower capital gains tax rate, can you apply the 3-year bring forward rule even if you plan to retire within the next 12 months?
Yeah, thanks, Dale. The 3-year bring forward rule, the only considerations is one, age. So you can make non-concessional contributions all the way up to 28 days after the end of the month you turn 75. It's a pretty interesting one. But then the second one is your super account balance. So to be able to bring forward the 3-year rule, which is 360,000 this financial year, your balance needs to be under, it's like 1.7 million to be able to use the bring forward rule. So one, age, and then two, what your total super balance is.
Awesome. Thanks, mate. Another question from Anonymous. So this one will actually be for Adam as well too. Well, sort of both, but I'll let Adam have this one. Do we still only pay 10% tax on shares as a non-resident, and therefore it would not be helpful to put this into super?
Yeah, so super is its own taxable environment. It doesn't matter if you're a resident or non-resident, it's taxed the same.
Yeah, but I think they're more talking about if you put it in your own name as opposed to super. Yeah, you're better off putting it into their own name.
Yeah, look, for the time period that you're a non-resident, depending on what jurisdiction you're in, like for example, in the UAE, you wouldn't pay tax on capital gains. There may be a slight withholding tax on dividends depending on where that share is held and where you're a tax resident of. So look, it's about doing that calculation and kind of feeding into the question before, we can still make those lumpier contributions to super later in life as well. So it's whatever is most tax effective for your situation.
I think we also talk to clients too, the importance of liquidity. You know, it's okay to put money into super if you think it's tax efficient, but if you're 30 years of age, you can't touch it for another 30 years. So the answer might be both. It's not always about the net tax position. tax is a very important part. That's what makes our world go round. But also to liquidity. Do you need to be able to put your hand on that money? Is an important one as well too. Okay, Ben, back to you, mate. Is the main residency capital gains tax exemption at all affected? Currently renting a negatively geared property.
Yeah, so there's been no mention of any changes to the main residence exemption at all through this. So that is, I guess, positive. So, but again, reiterate, you have to be a tax resident to activate the main residence exemption.
Okay, fantastic. Adam, back to you. We're playing tennis here. From Leon, I don't have property in Australia, but I do own shares, high growth strategy. Your recommendation will be to document the cost basis on the 1st of July 2027 and then continue to DCA as normal, or is there a different strategy that needs to be explored for shares?
Yeah, so look, depends if you're a resident of Australia or a non-resident. If you're a non-resident, you don't really need to document 1 July 2027, as assets will be CGT free from an Australian tax perspective. If you are an Australian resident, I think Ben would like if you documented what your share values were on 1st July 2027, because essentially from that date forward, it's a different calculation. Yes, you can still DCA as normal. That makes Ben's job a lot more difficult, because think about it this way. If I buy 10 shares on 1 July 2027 and then the next year I buy 10 more, those are two different calculations that have to be indexed from a cost-based perspective on 2 different days. But yes, the DCA strategy still applies.
Awesome, mate. Thank you. Question for you, Ben, from Josh. Is there any impact if we purchase property or shares that are not in Australia while a non-resident, but then we sell it in the future as an Australian resident?
Yes, so effectively that would be non-taxable Australian property. So for the extent of time you're outside of Australia as a non-resident, not subject to CGT, but as soon as you come into Australia, it's brought within the CGT net of Australia, and you're deemed to have acquired that art for its market value on the day that you become a resident. So from that point in time, the normal Australian rules apply. So indexation would apply to that property going forward. Potentially main residence exemption could apply if it was a place you lived in it previous to coming to Australia, but nothing until you come to Australia, and you'd at least get a step up at minimum of cost base being the market value on arrival.
Awesome. Thanks, man. Okay, another question for Adam from Anonymous. What is the impact, if any, of the trust changes on investment funds, bracket non-super, for example, those held within net wealth? Are those outside the scope of the changes on trusts?
Yes, they are. They are one of the exclusions of a type of trust. So net wealth is a type of trust. It's all around the individual and what the personal circumstances are for tax considerations.
Okay, question from for Ben, actually, from Tristan. UAE resident, non-resident for tax purposes back in Oz. No property, but I have a share portfolio in Oz. Post-budget, is the rule still the same that essentially if I became a tax resident again, the CGT gain resets to zero?
Depends on whether you held any of those assets before you left and you did deemed disposal. For anything that you purchased whilst you were non-resident, then yes, that deemed acquisition applies. So everything resets back to the market value as the cost base. But for anything you didn't deem disposed and held when you left, then you are treated as if that was one ownership period and you don't get a reset of that amount. And that deemed disposal was a one in all in thing. So you either did it or you didn't when you left. So the short answer is yes, if you deemed disposed or started the portfolio after Australia, but no, if you had deemed disposal assets prior.
Awesome. Thanks, Matt. Question from Anonymous. Do properties have to be valued to calculate the capital gains tax across the two different periods with the two different tax rules, or is the capital gains tax calculated pro rata?
So they're talking about the CGT discount here, I'm assuming, and the...
Yeah,
So
and then the indexation method after.
So my expectation is, so from up to 1st July 2027, you're going to have 50% still applying. So if you sold it before then, it's just the 50% rule. If you sold it after then you're going to have two periods. You're going to have the period up to 1st July, for the gain that accrued up to 1st July 2027, my understanding is you can get a valuation at that point in time, and anything that had been your gain up to that point is grandfathered, and anything after that is indexed. So I'll have to confirm that through the legislation, but that's my expectation. Is that your reading of it, Brett?
Yeah, mate, pretty much the same. Pretty much the same. Okay, question from Bill. Would a build on an existing property be considered a new build, either to demolish or renovate?
Yeah, we had a bit of a chat about this, and really the key from the budget is they're looking to provide the concession to those builds that increase the housing supply. So my expectation is that a knockdown rebuild one for one is not going to qualify for the negative gearing concessions. Now, obviously, it's irrelevant if you owned that at budget night, but we're talking about purchases after budget night. But as soon as you sort of split that and have multiple dwellings, that's when you're eligible for these for the continued concession on the negative gearing aspect.
Yeah, so essentially, is it if it's adding supply into the market, potentially, once again, devil's in the detail of the legislation. But if it's a one for one, then yeah, the only person benefiting is not society but yourself. So, okay, next question from Anonymous. If you return to Australia to live, is there a recommended time frame that you wait before selling your home that you have owned for 15 years and never rented out so you do not have to pay capital gains tax on the sale?
Not particularly. What the ATO will do when they're going through the conveyancing process and you're doing the clearance certificate application is they'll be interfacing the data they've got through immigration as to where you are at the time. There's questions in that certificate that says, are you an Australian tax resident or not? And you're attesting to that. But the secondary question is, has that changed since your last tax lodgement? So that's where you get to say, yes, it has. I was a non-resident, but now I'm resident. So then they can kind of join the dots together with your immigration data, have a look at what you put on your arrival card, make sure there's no major issues there. So I don't think necessarily waiting a couple extra months or whatever is going to change that scenario. If you do get questions, you can almost substantiate that in other ways. I wouldn't necessarily be waiting, but do not sign a contract prior to arriving in Australia.
Spot on. It is a different one, and I love how Aussies just think so obtusely sometimes when it comes to tax. Would assets such as watches, gold, or jewelry be captured by these changes?
So personal items are typically outside of capital gains, but precious metals are always considered as part of capital gains. So yes, they are captured to the extent that they're considered CGT assets, but you need to consider whether or not something's a personal use item or not. A watch may not, like I said, but gold bars definitely would be.
Okay, awesome. Another question from Anonymous. We just moved back to Australia after 25 years of living overseas and have a property which is over 30 years. So obviously they didn't really say whether they lived in it for 5 years, then moved, or anyway. And as you can see, folks, particulars are the area we do focus on. Could you please clarify how capital gains tax is calculated and they're retired?
Mm-hmm. Well, broadly, you start with working out the gain on the property, which is the cost base, the sales proceeds minus the cost base, and the cost base will vary depending on a range of different factors. Sometimes it's reset in certain circumstances on leaving the country. But once you've got your gross gain figure, you reduce that by any available main residence exemption fraction, which looks at the time you lived in it plus any absence period which is applicable. Again, it's not applicable to you if you sell whilst non-resident, but assuming you've come back now, as you mentioned, then that should be reactivated to the extent you lived in it. Then you apply any available capital losses that apply to that you might have been harbouring. Then you apply any capital gains tax discount that is available depending on your ownership period, and that will be different depending on whether you're resident or non-resident for some of that. And then you apply any revenue losses on top of that as well to give you a net amount. So there's quite a bit of a process, and there's so many different permutations within that that could change depending on your factors. We would recommend, if you want to get something specific, you reach out to us and we can actually run the numbers on your specific circumstances.
Great, thanks, mate. Another question here, and I'll take this one just so I can say I participated and was useful sometimes. Question from Anonymous. With these changes, does investing in foreign property and shares offer a better strategy than Australian property and shares, considering the deemed acquisition rules on returning to Australia? The answer is no, because tomato, tomato. If you own shares in Australia and shares overseas and you move back to Australia on the 1st of July, both of them will be taxed the same way, regardless. What it does do is adds complexity. And what we often see folks with visions of grandeur of having a global empire end up scaling those things back within the first 12 months of trying to rent properties overseas and deal with foreign brokerages when you don't have a foreign account. It does get messy. So simplicity, as Adam and I and the rest of the financial planning team often say, the best financial advice is simple advice. Clean, elegant. The more complicated you make it, accountants love you. Sorry, Ben, block your ears. Accountants love you because they can charge more because there's a lot more complexity to your work. But when you come back into Australia, if you own assets overseas for a valid reason, that's okay. But it will be treated no differently as an Australian tax resident as if you own that asset back in Australia too. Ben, you got anything else to add on that, or Adam?
Yeah, I'll just say one comment there. They do mention not just shares, but foreign property versus Australian property, and that's where I think you'll delineate those two treatments.
Yeah.
To the extent of foreign property, yes, I think there is some sort of advantage there in the sense that you get that market value step up where you don't get that with taxable Australian property ever. So yes, in certain circumstances, foreign property may be attractive. Depends on where it is, if it's taxed in that other country as well. There's a lot of non-tax issues that might have, apply there as well.
Okay, fantastic. Adam, you got anything else to add there, mate?
No, I was going to pick up on that foreign property. Just for that anonymous question, your foreign property will be valued even if you return to Australia, if you sell that while still an Australian resident or leave, the deemed disposal rules will apply. So Australian residents are taxed on worldwide income.
Okay, another question from Anonymous. Everyone's got the same surname. If you don't get any property assets valued at 1 July 2027, how will the ATO value the asset at 1 July 2027 to calculate capital gains tax? I'll answer this and I'll throw it over for the real answer to Ben. In their favour is all I'll say. They'll give you a rate. You want that valuation nice and high, but I guarantee they'll make it nice and low. Ben, you want to give the official professional answer?
Yeah, look, it's a good question. I don't know the answer to that. I would suggest that your obligation is to come up with a valuation on that date by the way you put your tax return together. And what's always required is that you use a suitably qualified valuer to be able to determine that. It's not something you can just pluck out of the sky, which is why we were mentioning, valuers might be sitting on a bit of a gold mine at the moment. There'll be definitely people who don't do that and they come up with their number, but the ATO, like you said, Brett, it's their prerogative to come up with an alternative valuation that is much lower.
Yep, 100%. If you want to see a value in 12 months' time, they're the ones driving the Lamborghinis. They'll stand out very well. Okay, another question from Anonymous. For the non-resident, do we need to mention full salary to the ATO yet, as we don't pay tax on it here in Saudi Arabia? But I have heard that when you go back, I'll be taxed. Oh, I'm sort of not really sure what the question is there. Sorry.
I think it's in the tax returns you need to put the foreign income. So typically you wouldn't unless you've got a HEX or a help debt. If it's just purely exempt income, you don't need to disclose it as such. So it doesn't get taxed if you come back to Australia and it was genuinely non-resident, income derived was non-resident and it was foreign sourced income. So I'm not sure if what you've heard is perhaps incorrect.
Look, Adam and I, and actually Ben yourself too, has been to Saudi and for work and talking to expats, and it's probably the home of the biggest myths when it comes to expat land over there. We hear some doozies. So I always say, get advice, get personal advice that relates to you. Sometimes someone will tell you information and that's correct for them, but it might be different for you because everyone's very different. And remember, when it comes to residency and tax, there is no black and white. It's very grey. So make sure you get information that relates to you and pertinent to you. Okay, next question. I'm thinking of selling my shares acquired as a non-resident. Will that be subject to CGT if I return back to Australia after selling them beforehand? Ben?
No, that would be outside of Australian tax land.
Yep, nice and easy. Okay, another question from another anonymous. Would a new build qualify if you subdivided the land that you own that has an existing rental property on it? If yes, I presume nominating the 50% capital gains tax discount is advantageous over the cost basis indexation method. Look, you'd think so, given that we worked out you have to get a 4.7% average indexation over 15 years if you want to be better off. But Ben, I'll hand it over to you to sort of clean that one up.
Yes, there's kind of two parts to this. So the new build aspect is relevant for the negative gearing component. So that depends if you're renting it out past then. So would be continued to be maintained on that if you were adding to the supply of properties. But the 50% discount is not really a choice you get to make unless if you're past 1st of July 2027, there's likely going to be a period where you have to apply indexation after that. So you need to consider when you're selling it. If it's before 1st July 2027, you can just take the 50%, but after that, no. And the assumption here is that you're Australian tax resident. Otherwise,
Yep.
this 50% discount may not be applicable. So if you're non-resident, then maybe the indexation actually works better for you because that is available as opposed to the 50% discount, which may not be.
Yeah, that's right. We want to see that devil in the detail, that we make sure there's no carve out for expats. As quickly as we get through these questions, gents, they keep building up. So let's dial it up. Quick statement here from Andrew, not a question. Why would anyone want to return to Australia? Question, exclamation mark. So yeah, I think there could be a lot of, say, one-way traffic, but certainly outbound will be busier than inbound. Question for Adam from Ben. Are there any macro changes, adjustments to Atlas's investment recommendations to clients with respect to attractiveness of asset classes based on these changes, or are you waiting for specifics on the legislation?
Yeah, look, we are looking for what comes through to legislation. Obviously, it is highlighted that, us being overseas, shares are still a tax-effective investment. Australian property has actually taken a bit of a hit, but also may benefit in terms of cost-based indexation as opposed to us not getting it now. But yeah, sit and watch, Ben.
Fantastic, mate. Thank you. Question from Anonymous. Please help us understand what you mean by reset for capital gains tax purposes. I think it might be referring to deemed acquisition.
Deemed acquisition. Yeah, look, if it's in relation to deemed acquisition, it's effectively just that you are deemed to have acquired an asset for its market value on the day you become a resident. There's a good article we've got on our website which talks through that at detail. If you were to look up deemed disposal, Atlas Wealth blogs, you'll be able to find that article and it goes through it in some detail.
Okay, thanks, mate. Question from Anonymous. Regarding capital gains tax, I thought it was pro rata, i.e. for the total capital gain between 2020 and 2030, of which 70%, that's 2020 to 2027, will be 50% capital gains discount, and 30% from 2028 to 2030 will be indexed. So no valuation necessary, and tax is purely calculated pro rata. Did I get this wrong?
I think there's actually a choice you can make. So you can actually get a valuation. Again, I haven't seen the detail of it, so we'll wait and see. But my expectation is there's a valuation you could get at that point in time and capture it, or yes, you could take a pro rata approach.
Yep, fantastic, mate. And as we keep saying, the devil's in the detail. We will have more information to explain once we have that legislation, which leads me on to the next question from Josh there. Do we know when the draft legislation will be available? Normally, Ben, it's 3 to 4 weeks after budget.
Yeah, look, I think it depends on how complex some of this stuff is because they normally get external providers to do that. And there's not just this, but there's so many different flow-on connective legislation links that they need to consider. So I think it might be longer than that. So we'll wait and see. Hopefully the sooner the better, but I don't have an exact time frame, no.
Okay, amazing. And last question here. I have an off-the-plan property in Dubai, currently non-resident. I'm planning to return to Australia in a couple of years' time. If I sell the property at original price after I return to Australia, will there be any tax implications, or would it be better for me to sell the property before heading back to Australia? So I guess currency's got a bit of play there, isn't it? But Ben, do you want to clean that one up?
Yeah, so the key thing is not the original price, right? So when you arrive in Australia, you're given the cost base being the market value on the day you arrive. So say it had gone up by 100,000 and then you sold it for the original price, then you actually get a tax loss of the 100,000 when you come back. But if it goes the other way, that it had dropped 100,000 by the time that you arrived back in Australia, then and you sold it for the original price, so then you'd actually be sitting on a gain of 100,000, if that makes sense. So we're looking at the difference between, so any gain or loss after you arrived in Australia, effectively. That's what we need to consider there. So, but if you did sell before you came back to Australia and therefore the whole ownership period you were non-resident, there wouldn't be any capital gains tax to consider at all.
Yeah, I was trying to explain to a client last week how you can actually pay tax on losing money. And the reason being is that actually bought, let's say, $1 million. But when they moved back to Australia, deemed acquisition was at 900 and then they sold it for $1 million or 950, I think is the example I use. So they're down 50, but in the ATO's eyes, they've made 50. So they shouldn't have paid capital gains tax. So it's yeah, as you can see, guys, it keeps us on our toes, and no wonder folks out there get caught up time and time again. So guys, that is the last question. We've gone over time a little bit. I really appreciate everyone's attendance, questions, participation. If you do need to take this further, I've chucked up on the screen there the website, atlaswealth.com. Feel free to go in there, hit the contact page. We've got folks everywhere that can help, whether it's financial planning, asset management, tax, mortgages, the whole shebang. Everything's changing. So if you think about mortgage side, as I said before, Macquarie was the first come off the rank saying we're not going to allow or factor in negative gearing into people's serviceability calculations. So that's already having a big effect on their side. So once again, thanks very much, guys. We are going to be sending out a copy of the recording and the slide deck as well. So I'll let everyone carry on with their day, and we'll see you on the next episodes. Thanks very much, guys. Take care.
Cheers.